In this video, I'm going to demonstrate how to calculate the optimal portfolio of risky assets using Excel, and then also using Excel, calculate the proportion of an individual investor's portfolio that should be invested in the risky asset portfolio and the risk-free asset. So we're going to do this using the Markowitz portfolio optimization model. Within that model, there's a minimum variance frontier, and that's the lowest possible variance that can be attained for any given level of expected return. The global minimum variance portfolio is the portfolio of risky assets that has the lowest variance of all risky asset portfolios. And finally, the efficient frontier is the range of all investments that are within the minimum variance frontier and are above or higher, have a higher return than the global minimum variance portfolio. What you should consider is that we're going to look for the optimal portfolio which gives us the best risk-return trade-off, and that would lie along this minimum variance frontier within a set of a given risky asset. In this video, I'm going to look at 4 different stocks, and we're going to combine those in the best weights to give us that risk-return trade-off that is the optimal outcome. So the expected return for a portfolio is calculated as the weights of the assets within the portfolio multiplied by their expected returns. The variance of a 2-asset portfolio, and the 2 risky assets in this case are X and Y, so think of those as 2 different stocks, is calculated as the weight of X squared multiplied by the variance of X plus the weight of Y squared multiplied by the variance of Y plus 2 times the weight of X multiplied by the weight of Y multiplied by the covariance of X and Y, or how they move together. So if we generalize this out to more than 2 assets, we come up with the following equation, which is the sum of the weights multiplied together for each asset I and J. And so what we have here is, if we have just X, so it would be the weight of X multiplied by the weight of X, so it gives us X squared, multiplied by the variance of X, which is the covariance of an asset. A single asset is its variance. Okay, so this is the generalized equation for this specific equation when we take it to more than 2 assets. After we move past a 2-asset portfolio, it's necessary to use matrix multiplication to determine the optimal asset weights in the portfolio. So using matrix multiplication notation, this is what our equation would look like. We have the weights of the portfolio, of the assets of the portfolio transposed, multiplied by their expected returns. And you can see this in the document that accompanies this video. In Excel, the formula is going to look like this. Equals mmult, so that stands for matrix multiplication. Transpose, so we're going to transpose the column of weights, multiplied by the column of expected returns. When making calculations with arrays in Excel, type in the formula, but don't press enter. Instead, hold down Shift and Control, and holding those down, press enter. This tells Excel that you are making a calculation with an array, otherwise you're going to get an error, and then puts the curly parentheses around the formula. You'll see that in the equation bar in Excel. The variance of the portfolio is calculated as the weights of each asset in the portfolio transposed, multiplied by S. S is the variance covariance matrix, and I'll demonstrate how to calculate the variance covariance matrix in Excel, and then multiplied again by the weights of the assets in the portfolio. The standard deviation of the portfolio is calculated as the square root of the variance of the portfolio, and in matrix notation looks like this. S is the variance covariance matrix, as I mentioned before, and our equation looks like this, equals square root mmult mmult. Okay, so we have 2 products here, so that's where we're using 2 mmults, and then we transpose the weight, so we do that there. So we're making this multiplication, and then we're making this multiplication, and then again we press Control Shift, hold those down, press enter to get the calculation for the portfolio variance. So the optimal weights for assets in a portfolio are the ones that maximize the value of the Sharpe ratio for the portfolio. The Sharpe ratio for the portfolio is the expected return for the portfolio minus the risk-free rate divided by the standard deviation of the portfolio, and I'll demonstrate how to use Solver in Excel to do this. Finally, we want to say, okay, we've got this optimal portfolio of risky assets. Now we want to look at the individual investor, and based on their level of risk aversion, how much of their wealth should they put in that risky portfolio, and how much should they set aside and put in a risk-free asset? To do that, we're going to use this equation, which says that the proportion of the portfolio invested in the risky portfolio, Y asterisk, is equal to the expected return for the portfolio minus the risk-free rate divided by A. So A is a measure of the investor's risk aversion, multiplied by the variance of the portfolio. All right, so now we're going to actually use the information that we went through in the document to calculate first the returns, and then for the individual assets, and then we're going to calculate the variance covariance matrix, and then the weights of an equally weighted portfolio with the expected return and standard deviation, and then the optimal weights for the optimal risky portfolio, and then show you the expected return, the standard deviation, and the Sharpe ratio of that portfolio. And then finally, we're going to finish up with calculating the optimal amount that a risk-averse investor would put into the risky portfolio and the amount that they would put in the risk-free asset to make the complete portfolio. So on this page, I've given you the prices. These come from Yahoo Finance for 4 stocks: Bank of America, AT&T, Westar Energy, and Union Pacific. To calculate the returns, I'm just going to put in here equals and open parentheses the most recent stock price divided by the one before, minus the one before, divided by the previous month's stock price. And that gives me 2.38%. I can pull this across, and it's going to complete the calculation for the rest of these. And I can pull this down. I don't want to go down to the last row because it just gives me an error term. I'll show you that. So error term, we don't want that. We're going to take that out. So these are the monthly returns for each of these different individual stocks. So the average monthly return I can calculate is equals to average. I'm going to highlight the returns for Bank of America. And then close parentheses so it looks like average. Highlight all the returns, close parentheses. Again, I can drag this across. I get the little plus sign here, go across. I'm going to do the same thing for variance. Here I'm going to put in equals VAR. Again, I'm going to highlight these returns. Close parentheses. And this gives us the sample variance. If we wanted the population variance, we would put VARP. For now, though, we're just looking at a sample of returns, so we're just going to use the sample variance. The average annual return then is equal to that 0.8 multiplied by 12. And the annual variance is equal to our monthly variance, again, multiplied by 12. I can grab these, pull them across. So as we see here, AT&T has a much higher variance than anyone else, and a lower return, so not a terribly attractive investment at this point. We're going to see, though, if it can add to the value of the portfolio by combining it with the other 3 stocks that we have here. So I'm going to go up here, and it says returns. I don't want to type in the returns here. I just want to set them equal to the annual return below. So Bank of America was 9.91. AT&T is equal to 10.44. Westar is equal to 15.67. Then Union Pacific is equal to 13.99. At this point, we're going to calculate the variance covariance matrix. And it's easier to name our arrays, so our arrays of returns for each stock, so that we can put them in here easier. So that's what I'm going to do now. Where we name our cells or our arrays is up in this box where it currently says Q1. So what I want to do here is I want to highlight all the Bank of America returns. And I'm going to put in here BAC, that's Bank of America's ticker symbol, RET for return. So now that array, whenever I reference BAC RET, I'm referencing that whole column. Okay. The next one, I'm going to use AT&T. So I highlighted all of the percentages there. And I put ATT RET. The next one for Westar Energy. Again, I'm going to highlight all of their returns. And I'll put in Westar return, RET. Then finally, I'm going to highlight Union Pacific. Their ticker symbol is UNP. So I'm going to put in here UNP RET. That makes life a lot easier. The reason why I didn't do that before was that if I had done that and I would have put average BACRET here and then pulled it across, it would have just pulled across, it would have referenced the same array and would have just been 0.8, 0.8, 0.8 for each one of those returns. So we didn't want to do that yet. So now I'm going to calculate the variance covariance matrix. To do this, I'm going to put in equals covar for covariance. And in this case, we're actually calculating the variance, but just to be consistent, we'll use the same command in each one. Covar, here it's going to be BAC return, BAC return. And to get the annual covariance, I'm going to multiply by 12. Okay. For the next cell over, I'm going to put in equals covar BAC return, AT&T return, multiplied by 12. For the next one, I'm going to put in equals covar BAC return, Westar return. There we go. And multiply that by 12. And finally, I'm going to put in covar BAC return, UNP return, multiplied by 12. So as you can see, I took BAC, or Bank of America, Bank of America, Bank of America AT&T, Bank of America Westar, Bank of America Union Pacific to get this row. The variance covariance matrix is symmetrical, meaning that the covariance of Bank of America and AT&T is equal to the covariance of AT&T and Bank of America. So I can just set this equal to the one up there, set the Westar Energy and Bank of America to the same as Westar Energy and Bank of America, and then finally Bank of America and Union Pacific. And then I just continue to do this for the rest of the variance covariance matrix. So here it's going to be the covariance, the AT&T return and the AT&T return multiplied by 12. This is the covariance of AT&T and Westar Energy, again multiplied by 12. And this is the covariance of AT&T and Union Pacific, and again I'm just going to set these equal. For the next row, it's going to be the covariance of Westar Energy and Westar Energy multiplied by 12. The covariance of Westar Energy and Union Pacific multiplied by 12. And then finally, it's the variance of Union Pacific. So we're just going to put in Covar Union Pacific return, UMP return, multiplied by 12. Okay. So now we have our variance covariance matrix. And so now we can calculate the expected return and the standard deviation of returns for our equally weighted portfolio. So our equally weighted portfolio, our weights are going to be 0.25, 0.25, 0.25, 0.25, and then I'm going to put in here equals the sum of those, and it has to be equal to 1. So our expected return, if we go back to the document that we went over earlier, our expected return is going to be equal to the weights transposed, so we get a row instead of a column, multiplied by the expected returns. Alright, so to calculate the expected return then, I put in equals mmult for matrix multiplication, and then the word transpose, because I want to turn my weights, my column of weights here, into a row of weights. So I want to highlight these weights, close parentheses, comma, highlight the returns, close parentheses, and here's where I'm going to hold down Shift and Control. So Control Shift, hold those down and press Enter, and you should get 12.5%. The standard deviation is a little more complicated. Again, taking back a look back at this document here, I give you the command for it, and it's equal square root mmult, because we're making two multiplications. The first is the weights multiplied by the variance covariance matrix. The second multiplication is here, the product of these two multiplied then by the weights again, and then the square root is because we take the square root of that to get the standard deviation. So to calculate the standard deviation of the portfolio, I start with equals square root mmult transpose, open parentheses. Here's where we put the weights in, again because we're taking them from a column to a row, close parentheses. Then we're going to multiply those transposed weights by our variance covariance matrix, close parentheses, comma, and then we're multiplying the product of these two again by the weights, but we don't transpose them this time because we're going for that one by one matrix, that singular number at the end, close parentheses, two close parentheses, then hold down Control Shift and Enter, and I get 12.52% for the standard deviation. So our Sharpe ratio in this case would be equal to the expected return minus the risk-free rate divided by the standard deviation. So I get 0.759153. So now what I want to do is see if I can do better than that. So I'm going to go down here to the optimal risky portfolio weights. I'm going to start with an equally weighted portfolio. So 0.25, 0.25, 0.25, 0.25 equals the sum. And that always has to equal to 1 in our portfolio. So I'm going to calculate the expected return to the standard deviation in the same way. Make sure to use these weights, not the ones above, because we're going to change these weights in order to get our optimal weights for our portfolio. So I have that information in just like I did above. Control Shift Enter, 12.5, it matches. So I didn't do anything wrong there. Equals square root, again mmult, transpose. Transpose, again use these weights, not the ones above, comma, my variance covariance matrix, close parentheses, comma, my weights again, close parentheses. You'll do, again, 2 close parentheses here. Control Shift and enter 12.52. That matches, so I'm happy. Then I want to calculate my Sharpe ratio because this is how I'm going to optimize my portfolio. I'm going to maximize my Sharpe ratio. So this is equal to my expected return minus the risk-free rate divided by the standard deviation is equal to 0.75913 or 759,153, just like up here. And so now what I want to do is use Solver. So I'm going to press Data. Up here I have Solver. If it is not installed on your Excel, here's how to do it. Go to File, go to Options, go to Add-ins. So down here it says Manage Excel Add-ins. I want to go to that. And then you'll want to select Solver Add-in if it's not already selected. So make sure there's a checkbox there. Again, I'll walk through that. I go to File, Options, Add-ins, Excel Add-ins down here at the bottom, go, and then select Solver Add-in. Once you do that, if you select Data, go to Solver, it should pull this up. It should be blank for you. I'm going to reset it all to walk you through it. So our objective is to maximize the Sharpe ratio. So set objective, the number for the Sharpe ratio right here, to maximize, make sure that max. By changing what variables, so we're looking for the optimal weight, so we're going to select our weights. And then we have to subject it to the constraint that the sum of these weights are equal to 1. So add the cell reference. This is equal to 1. Press OK. And then the next box down here, this is important. So make unconstrained variables non-negative. Our unconstrained variables are going to be our weights. So by saying that they have to be non-negative, we're saying we can't, we've already said the sum of these has to be equal to 1, but now we're saying none of these can be less than 0. So make sure that is selected. Press Solve. It says we found a solution. We're happy, we got a solution. Here's what it looks like. So like before I said, when we looked at the expected return and the standard deviation, that Bank of America wasn't very attractive. At least it's not 0 here. It could be a 0 weight. It's very low. We're saying we only want 3.8% of our risky portfolio to be in Bank of America. The other ones are pretty evenly spread out. Westar Energy is about half our portfolio based on its historic performance. AT&T and Union Pacific are 29 and 19% each. That gives us a much better Sharpe ratio. We went from 0.759153 to 1.016287. So we improved our risk-return trade-off fairly dramatically by changing the weights in our portfolio. Finally, we're looking at this from the point of view of the risk-averse investor. So if we go down here, we know that our proportion in the risky portfolio is equal to the expected return on the portfolio minus the risk-free rate divided by the level of risk aversion A multiplied by the the variance of the portfolio. So this is going to be equal to the expected return on the portfolio minus the risk-free rate, open parentheses, our level of risk aversion multiplied by our standard deviation squared. And the up caret here is, if you press Shift and the number 6, you get the up caret, squaring it. I don't have to hold down Control Shift in this case. I just hit that. So what this means is that 97% of our portfolio would be put in the risky asset or the risky portfolio, and then 3% would be in our risk-free asset or our T-bill or money market fund. If I change these numbers, that proportion is going to change. So if I go from a risk-free rate of 3% to say 6%, the risk-free asset becomes more attractive. We would put 30% in the risk-free, 70% in our risky portfolio. I hope that was helpful. Please let me know if you have any questions on how to calculate the risky portfolio or the allocation of funds into the risky portfolio or the risk-free asset for our complete portfolio.